We always hear that accounting is an information system that measures, processes, and communicates financial information about a business. But without knowing how are they actually measured, processed, and communicated, we will not understand it enough. So let's visualize the accounting process. Transactions will undergo through four phases to reach the financial statements. First one, identify. Business transactions and events are the starting points of financial statements. Examples are transactions with suppliers and transactions with creditors. Business transactions are supported by source documents, such as official receipts or sales invoices. There are other different source documents that correspond to various business transactions. For example, cash registers record each sale on a tape or electronic file. This record is a source document for recording sales in the accounting system. Source documents are objective and reliable evidence about transactions and events and their amounts. Source documents identify and describe transactions and events entering the accounting system. They can be in hard copy or electronic form. Transactions are almost always measured as they occur, and some are measured during the analysis phase. Next, analyze each transaction and event using the accounting equation. The accounting equation ensures that the total of all the company's assets equals the sum of the company's liabilities and shareholders' equity. Assets are resources owned or controlled by a company, and these resources have expected future benefits. Most accounting systems include separate accounts for each kind of asset. Let's look at some common accounts. A cash account shows a company's cash balance. It includes money and any funds that the bank accepts for deposit. Accounts receivable are promises of payment from customers. A notes receivable or promissory note is a written promise of another entity to pay a specific sum of money on a specified future date. Prepaid accounts or prepaid expenses are assets from prepayments of expenses expected to be incurred at a later period. Common examples of prepaid accounts are prepaid insurance, prepaid rent, prepaid services. Prepaid accounts expire with the passage of time or through consumption. Similar to prepaid expenses, supplies are assets until they are used. Don't confuse supplies with inventories. Supplies are consumable items that you use in the daily workings of your business. Inventory, on the other hand, refers to anything you will either sell or use in making a product you will sell. Equipment are properties acquired to be used in producing goods or services. Buildings such as stores, offices, warehouse, and factories accommodate the operations. Note that rented buildings are not recorded as properties unless they fall under the definition of capital lease. The cost of land is recorded in the land account. The cost of buildings located on the land is separately recorded in the buildings accounts. Liabilities are obligations to transfer assets or provide products or services to others. They are claims by creditors against assets. Common liability accounts are described here. Accounts payable are promises to pay later. Payables can come from purchases of inventory, supplies, equipment, and services. A note payable is a written promissory note to pay a future amount. A note payable is different than an account payable because it comes from a formal contract called a promissory note and it requires interest. It is recorded as either short-term or long-term note payable, depending on when it must be repaid. While a payable refers to a liability that must be paid, an earned revenue is a liability that must be fulfilled. It is fulfilled when a company delivers its products or services in the future. Examples of unearned revenue include magazine subscriptions collected in advance by a publisher, rent collected in advance by a landlord, and season ticket sales by sports teams. Accrued liabilities are amounts owed that are not yet paid. They accrue or accumulate continuously over time, but are paid periodically. Examples are wages payable, taxes payable, and interest payable. The owner's claim on a company's asset is called equity. Equity is the owner's residual interest in the assets of a business after subtracting liabilities. Equity is impacted by four types of accounts. When an owner invests in a company, it increases both assets and equity. The increase to equity is recorded in the account of that investor. When an owner withdraws assets for personal use, it decreases both company assets and total equity. Withdrawals are not expenses of the business. They are simply the opposite of owner investments. Amounts received from sales of products and services to customers are recorded in revenue accounts, which increase equity. Examples of revenue accounts are sales, commissions earned, professional fees, rent revenue, and interest revenue. Revenues always increase equity. Expenses are the costs incurred in providing products and services. Expenses decrease equity. Examples of expense accounts are advertising expense, salaries expense, rent expense, utilities expense, and insurance expense. The foregoing are the basic accounts common to almost all businesses. There are many other accounts depending on the nature and size of the business. We also organize assets and liabilities into subgroups that have similar attributes. This will be explained in detail in a separate clip. As each transaction is analyzed, it proceeds in the recording phase. In recording, accounting uses the double entry system. In this system, every transaction to be recorded will have to involve at least two accounts, with at least one debit and one credit. The total amount debited must equal the total amount credited, ensuring that the accounting equation will hold true at all times. Recording transactions in a journal is called journalizing. Journalized transactions are then reviewed for approval for posting to the general ledgers. The general ledger contains the summary from which financial statements is based from. Again, journals show the transactions, while ledgers summarize the total amounts per account. At the end of the accounting period, the contents of the ledger will be summarized to different statements that comprise the financial statements. These financial statements will be used by those who need accounting information of the business, such as regulators, potential investors, and external stakeholders. However, take note that these financial statements go through an audit before issuing to the users. An audit is conducted to provide an objective, independent examination of the financial statements, which increases the value and credibility of the financial statements produced by the management. Audit therefore increases user confidence in the financial statements. To sum up, accounting is an information system that measures, processes, and communicates financial information about a business.